You want to buy a house in Canada, you need to get a mortgage, but you're trying to figure out what the difference is between a fixed rate, a variable rate, a static variable rate, insured mortgages, uninsurable mortgages. What does all this mean? I'm here to explain that to you. Hey there, and welcome back to Bald Prairie Real Estate. My name is Matthew Pfeifer, real estate agent in Regina, and that's my trusted assistant, 𝗤𝗲𝗄𝗧. I got this very excellent question from a viewer asking all about mortgages. I said, I gotta make a video on this. If you have a question that you have burning in the back of your mind, you want me to answer it for you, put it in the comments below. I'll be happy to answer it and maybe make a video about it in the future. So we're gonna be talking you through all you need to know about mortgages, types of mortgages, and why it matters. But of course, we gotta start this off as we always do with another one of my terrible bad dad jokes. What do you call a bear with no teeth? A gummy bear, of course. If you have a terrible joke I can use in a future episode, put it in the comments below. Let's learn about mortgages. In Canada, there are three types of mortgages: insured, insurable, and uninsurable. That is whether the mortgage has mortgage default insurance. Most people refer to this as CMHC fees because CMHC used to be the largest provider in Canada. They've actually now been overtaken by their two private competitors. So let's dive into these types of mortgages, and then we're going to talk about different types of mortgage rates. An insured mortgage is when you, the purchaser, have a less than 20% down payment. It's a requirement then. The purchase price is under $1.5 million. It's for a primary residence or a cottage, and you as the purchaser will have to pay for this mortgage default insurance. It'll get added to your mortgage. An insurable mortgage is when you, the purchaser, have more than a 20% down payment, but that purchase price is under $1.5 million. It's for a primary residence or cottage. The lender now has the choice to back end insure this, but you as the buyer are not going to be paying for this insurance. A mortgage that is uninsurable is when it's for a property that is over $1.5 million. It's for an investment property. Those are always uninsurable. All refinances are always uninsurable, as are any purchases where the purchase is going to have longer than a 25-year amortization. Why does this matter to you as someone who's looking to buy a house in Canada? Well, when you are having an insured mortgage or insurable mortgage, you're typically going to get a little bit better interest rate than an uninsured mortgage. Now, if you haven't subscribed to Bald Prairie Real Estate, you should. That button's right down there, because each and every week I do a weekly news recap and I give you the best mortgage rates available for that week. Also, if you have an insured mortgage or it's a requirement, generally it's actually a little bit harder to qualify for the mortgage. I've seen people say a lot online how these buyers, they call them subprime because they have the smaller down payments. And that couldn't be farther from the truth. Everybody in Canada has the same lending criteria, but when you have an insured mortgage, then you also have to have the insurer sign off on the deal. So essentially, two different independent parties have to approve the deal. If either one of them doesn't do it, the other one won't, and you won't get your mortgage approved. I have a buyer right now where the insurer will not approve the house. The buyer is more than qualified to buy it, but they don't want to sign off on the house, and we can't do the deal. Now let's talk about different types of mortgage interest rates. You have two major categories with one subcategory. First up is fixed rate mortgages, which about 75% of Canadians typically will take. That means that for the entirety of your term, whether you take a 1, 2, 3, 4, 5, or even a 10-year term, your interest rate will not change for the entirety of that term. This means that you have stability, you know exactly what your payment's going to be for that entire term, and a lot of buyers typically like this because they know exactly what their mortgage is each and every single month. Generally though, historically, fixed rates have been a little bit higher than variable rates, but of course now you have that security. Next, let's talk about variable rate mortgages. These have been all over the headlines recently. They fall into two categories, starting off with adjustable rate mortgages. That means that every time the Bank of Canada changes its interest rate, your mortgage rate will also change as well. If interest rates go up, your mortgage payment's going to go up. If they go down, your mortgage payment will go down. Let's talk about static variable rate mortgages. I think this is probably the most misunderstood mortgage type in Canada. You have a static or fixed payment, meaning it doesn't change for the entire term of your mortgage. Again, same type of terms as with fixed rates, but you now have a percentage of that mortgage that will be interest, a percentage that will be principal. As the Bank of Canada changes interest rates, the percentage that goes to interest versus principal will fluctuate within that fixed payment. So for a simple argument here, let's say your mortgage payment is $1,000 a month, $500 goes to principal, $500 goes to interest. Bank of Canada increases rates, now $600 goes to your interest, $400 goes to principal, the payment stays $1,000 every single month. Where people have gotten themselves in trouble recently is when interest rates have increased dramatically, like say over 5% in a year and a half, as the Bank of Canada recently did. Then potentially they get to a point where the entire payment becomes interest, or in some cases more than the payment becomes interest, meaning that not only are they not paying down their mortgage if it's all interest, but if it is more than the payment is interest, then they're actually seeing time get added to their mortgage. And that is where you've seen these headlines of 70-year mortgages, because effectively at their current payment, it would take 70 years to pay off that mortgage. But where I think a lot of people get mistaken is that no, they are not going to have 70 years to pay off that mortgage. And no, you can't go to the bank and say, I would like a 70-year mortgage, please.
Well, I'm sure.
Effective amortization, again, means how long it's going to take to pay off that mortgage at the current payment, versus you have contract rate, which is your required timeline to pay off the mortgage. Again, in Canada, you typically do 25-year amortizations, or in some cases, 30 years. So even if you have an effective amortization of 70 years, you still have to pay it off with whatever your contract was. Meaning that when you come up for renewal, you either have to catch up to make sure that you're back on track if you were behind, or you're gonna have to start making lump payments ahead, and you will see your payment probably go up at renewal, so you get back onto that 25 or 30-year term, whatever it was. You can't go beyond your contract term, no matter how long the effective amortization may be. And this also works in reverse though too. If the Bank of Canada drops rates dramatically and more of the payment goes to principal, then you would actually be paying off that mortgage faster. Let's talk now about what happens if you decided to cancel that mortgage early. Say you found a lender with a better interest rate. Pretty much always there's going to be what's called a payout penalty for breaking that mortgage before your renewal date. Again, 1, 2, 3, 4, 5, 10-year term, whatever you've got. When it comes up for renewal, you will go and renegotiate with that lender or any different lenders and see if you can get a better interest rate. But if you decide to break the mortgage before then, there's going to be a payout penalty. When it comes to a variable rate mortgage, if that's what you've selected, more often than not, 3 months interest, and then you can go just pay that out and you will be on to the next lender. So variable rates typically have much smaller payout penalties. Fixed rates can have some very significant penalties though. What the bank does is they calculate what's called an IRD, interest rate differential. And essentially what they're doing is calculating the difference in the interest rate that you would have been paying versus what you are now, as the bank, going to lose in interest. When you go with a Big 5 bank, typically they calculate their interest rate differential on the posted rate, not what you are paying or not what the discount rates are, versus the new rate. And that's where you can see significant penalties, because it's the remaining interest for the entire term. And I've seen payout penalties on fixed rate mortgages be tens of thousands of dollars. So it could be a very significant penalty to go and move that mortgage. When you go with a monoline lender, and these are things like RMG, MCAP, these are lenders that only do mortgages, they typically calculate interest rate differential on the contract rate or the best posted rates available, or the discount rates, I mean, meaning that the interest rate differential is generally significantly lower with a monoline lender than it is with one of the Big 5 banks. If you have a great question about buying a house in Canada that you don't understand, you'd like me to answer for you, put in the comments below. I may make a video on it, but for sure I will answer that question for you. If you want to check out where the best rates are right now, right here is my weekly news recap, and you can find those best rates available. If you like this video, please give this video a like, subscribe if you haven't already. Why not? You'll miss out on all my great Canadian real estate market updates. And as always, thanks very much for watching.